Nice to be back to the familiar field of numbers. So, we have actually, in all our financial presentations, in the earnings call, in the earnings presentation, we've always focused on quarter what's happened. Non-mutual fund business has grown this, payment has grown that, insurance repository will grow, etc., etc. What we thought we will do, and that's what Anuj was alluding to in his earlier conversation, is that take a step back, okay? Take a step back and take a little bit of a medium-term to long-term view on what's happened on the financial metrics. So, they say that numbers never lie, right? And what you see in few charts with some numbers probably conveys a message much more than if I stand here for 10 hours and talk paragraphs and paragraphs of text and how well we have done, etc., etc. So what we have put together is a concise compilation of certain financial metrics. The metrics is all that we know, but we're just taking a step back and looking at how we have done over the last few years, over business cycles, booms and busts, over yield compression, the favorite topic for all of you here, yield compression, and customer wins, non-mutual funds, everything, right? So everything has to finally, all that you saw earlier has to add up in terms of some number, right? So how has that number been? How has it behaved over a period of last few years? And post this, my only submission is, it's all database, is that have a look at how we have done and financial metrics. And if there is any recalibration that you need to do on the way that we are going to perform in the future, I think this is a good indication of what will happen, because we always feel the future is better, right? The future is going to be better. So with that, I'll just start off. Just one clarification, you will see FY26 numbers. It's not a guidance from me. It's not a guidance from Anuj. It's not a guidance from the team. It's just, it'll be very odd for me to look at FY25 when I'm just 2 months away from end of year. So we've just put some estimation here. So what have we done in terms of revenue CAGR, right? This is total revenue, company revenue, MF, non-MF, everything put together. It's a 17% CAGR, right? Over the last 5 years, which is started at 705 crores. And the 5 years, the sanctity is that it's post-listing, right? So this is the time that we started listing. So we have actually grown 17% CAGR, 26 again based on this. Within this, how has the mutual fund revenue done? I'm going to talk less and show charts more. So the CAGR of mutual fund has been 22%, okay? And people who are talking about will mutual funds grow, for the last 5 years I'm listening, but every year the CAGR only increasing, right? So it's 22%, we are at 54 trillion now, obviously now Anuj was mentioning we are at much more than that, we have more than 56 trillion, but we are at 54 trillion average AUM. And then what has the mutual fund revenue been? The mutual fund revenue has gone up to, well, CAGR of 15%. This has got asset-based revenue and a non-asset-based revenue. And asset-based revenue has grown more than 16%, which is your usual 75% kind of correlation, right? So what has happened? 5-year CAGR has been an impressive 15% across market cycles, TER changes, price discounts, whatever you can have. All impact condensed in a single number, we have grown revenue a CAGR of 15% on the mutual fund perspective, right? Go to the next one. So we always talk about this, right? And every person asks us this question saying, how do we know? How do we correlate? And we always say, you generally there is a relationship between AUM and AUM fee growth. We say that you take it between 70 and 80%, right? And it's not something that we are saying because we like the number. It's actually based on what has happened in the past. Look at this 5-year CAGR, and I'm just as a rolling 5 year. So which means you see AUM here and fee growth here, 2014, 2015, 15, 11, 16, 12, 20, 16, 2016, which means AUM fee growth, and this is all over a 5-year period, okay? I'm not taking a particular year because it'll be out of context. So it's been between 74 and 80%. The point here is this is also the case if you take a 5-year on 26. So what's happened so far is we are actually looking at similar kind of long-term averages. So if you look at a BIPS reduction, again, extremely favorite topic for a lot of you, which is that what we again talk about a 3 to 3.5% in a normal year. Right? Again, that's not a number we're picking out of hat, right? There is some basis for all those things. So if you actually see it's been 3, 3.1, 3.8, 3.3, the 4.7% decline in yield on the 5-year CAGR is obviously attributable to the one-time price reset that we had this year, right? If not, the long-term average continues to be between around 3.5%. And that's the basis in which we quote these numbers to you. So I just wanted to give you context saying that all this is data-based. It's not something that we think is a hope. It's not estimate. It's all data-based. And then what happens to the non-mutual fund, our diversification strategy? Anuj actually went through this in detail. I'll just reiterate this. We started at a 69 crores in FY21. This year, anywhere between 250 to 225, assuming a mean is 220, which means impressive CAGR, more than impressive CAGR of 26%, right? Now, this is the actual position of numbers over the last 5 years, the actual trend over the last 5 years. And one more visibility, right? And this is something that probably we've not put as a chart, as Anuj said, and shown to all of you. But then what are we saying? We are saying that we have demonstrated cost optimization through productivity, technology, and general automation, right? So how is that actually seen? So I'm just putting in the left-hand side the transaction count, right? You've seen the AUM CAGR to be 22% in the earlier charts. I'm putting the transaction count, it's a CAGR of 26%. We are going to be more than 100 crore transactions in the current year, right? We started off 33 crore in FY21, right? So it's a CAGR of 26% as a proxy for the activity level, in the company, okay? Now what happens to this chart? And just please look at this very closely. This is the headcount chart, and this is, if there were any proof, you can have a look at this. FY21 to this, okay? It is an increase from 6,000 to 8,000 odd, but look at the components of the cost. This is actually the mutual fund core, which has shown this 17% CAGR increase. This is actually the call center cost, manpower. This is the technology where we keep on saying we've invested in technology, we've invested in what have we invested in? We have invested in technology. And then this is the non-mutual fund. Let's see how they have behaved, right? What is the average annual increase? For my mutual fund, just digest this number. For my mutual fund, for a CAGR of 16%, my headcount has grown an average of 5%, right? For the non-mutual fund, for a CAGR of 26-27%, my headcount has grown 8%. So where have we invested in? We have invested in this bucket, which is technology, which has risen almost like double over the last 5 years. So when I say the number of manpower has remained same or has increased and all those things, it's not as if we are putting people back into processing. It's not as if we are putting people back into other things. We are investing. And I'll just like to add that the sales component that we have invested is a part of this, right? So if you take that away, it's going to be much less than 5%. So the model is like that. So what we are saying is that this is a very efficient model, and we're making it more efficient by the day. And imagine this is before the entire thing that Sumendu spoke about, re-arc and all those things, is something in the future. When it happens, but I'm saying this is the past, okay? So what has this translated into? From an EBITDA and PAT perspective, 5 years, CAGR 18%. CAGR 18%, right? So we have demonstrated our ability to grow a profit, EBITDA and PAT at a rate that is much more than what our revenue is compounding at an impressive 18%, right? Again, please don't come to me 3 months later and say, why is it this 476, 482, but it's just an estimate as of now, right, in terms of net profit, right? And in spite of yield pressures, cost pressures, EBITDA has grown from 42% in FY21 to 45% in FY26, and my exit quarter was actually 46% EBITDA, right? Again, why we are saying all this is to just drive home the point that we run a very efficient business. It's a cash generating business. It's a profit accretive business. And I said in my video that we have done capital allocation very responsibly. we have not sat tight on the cash, right? So we have started investing. The fact that you're able to compound 27% on non-mutual fund means we have invested. We've invested on platforms, we've invested on technology, we've invested on people, and that's why you are able to build all the platforms that Anuj showed in terms of the time chart, right? Bima Central, WealthServe, and now we are building Consent Pro, several other things that we have built all now. We have invested in that. We have not let that mar the financial performance, and we are primed up for future growth from a non-mutual fund perspective. So I think this is what we are trying to say. But then every number seen in isolation gives you half the picture. So don't you think it's better if you compare it with someone? So, okay, we go and compare it. Let's compare, okay? This is a market benchmark. So we took the Nifty 50 companies, and we did till FY25, when that was a completed year that we had with us. So we did a 4-year CAGR. How did we look? Revenue growth, CAMS is the blue line. CAMS is the, black one, and Nifty is the blue one. So this is a 4-year CAGR, it's different from what you're seeing. So it's a 19% growth versus Nifty 500 having 16% growth. EBITDA, again, this is 22% because we did a 4-day CAGR, was a 17%, right? Much better. EPS or PAT, approx, both you can take is the same, right? We did a 23% growth for the last 4 years. Nifty 100 had a 16% growth. And the return on equity, we were number one even in our sector, which is the capital markets. But overall, 43%, very efficient use of capital. Nifty average is 17%, right? So I think this is again to reiterate and drive home the point that we have been very, very prudent from a financial perspective, and we have generated returns, right? And then this is the icing on the cake. So where do we stand in terms of ROE? We are in the top 5% of the Nifty 500 companies. In PAT percentage, we are in the top 10%, and the EBITDA percentage, we are in the top 15%. I just want to put these numbers before you, if in case you have not thought on these lines, to kind of think on these lines, and just to evaluate your impression and evaluation of CAMS, right? In terms of a financial performance, while there will be issues on yield, there is issues on cost inflation, there is interest on pressure, we have in a sustained manner delivered superior financial performance over the last 5 years. And that's the underlying message I want to leave with all of you. And I'm sure you will have questions on this later, but with this, I will conclude this presentation, and we'll see you in Q&A.